month. So we're going to walk through the calendar theory today. We have some cool visuals for you, and we're going to actually continue to kind of layer on these visuals as these earnings announcements come out and as these IV landscapes change. I think it'll be really good to hammer home the concept. All right, calendar theory 101. So when we're talking about calendar theory, we're really just talking about what you're doing and how you're adjusting a trade or strategy when you're selling near-term cycles and the near-term implied volatility relative to the back month implied volatility that you're typically buying. So when we're looking at calendar spreads, long calendar spreads typically involve selling a near-term option and buying a long-term option. Over the past few years, we've noticed that the implied volatility landscape has changed a little bit. When we used to trade earnings, we used to see heightened implied volatility in the weekly cycle, still heightened implied volatility in the 30-day cycle, and then as you trickled out in time, you would get lower implied volatility readings. But recently, we've kind of seen that the midterm implied volatility levels for different expirations, like the 30 to 60-day IVs, have been relatively low or flat. And with that in mind, we've been able to kind of do these strategies with earnings trades and other binary events where we're really taking advantage of the near-term cycles that have inflated implied volatility, and we're getting long the back months with a low expectation of a volatility crush. And we'll show you this with a couple of visuals, but that's ultimately the idea. And when we're setting these strategies up, we want to make sure that two things are true in the strategy. So we're looking at back month implied volatility or a longer term cycle. We would define this as 30 to 60 days or maybe longer. We've been doing a little bit longer term cycles recently, but we want to see these IV numbers on the Tasty Trade platform to be pretty flat. And when we say flat, we really just mean we want to see similar numbers across the board, whether we're looking at June, July, August, September. If the IV percentage numbers are similar, that's what we would call a flat implied volatility curve. Yeah. When we see this, we don't expect much of an IV crush. We're still going to see an IV crush, but we can't, as long as we can't really pinpoint what the IV crush is going to be, and I'll show you what that means in just a second here. But when we see similar numbers across multiple expirations, we know that the IV isn't really projected to crush in a big way. It still can if there's a non-move from an earnings announcement, but it would be significantly less than if we had visually different IV numbers, which we will be able to see in a second here. But really, the front month or front weekly expirations are the ones that we are getting short. They're going to be the shorter term cycles. Implied volatility is going to be more elevated, but how elevated is that number really is something we also need to dive into. But at the end of the day, the idea is that there's more implied volatility premium or extrinsic value premium relative to time in these cycles. So for an example, if you're looking at a 5-day option that's trading for $2, and then you look at a 30-day option on the same strike and it's trading for $4, well, in that case, you are getting 50% of the premium over the 5-day cycle relative to the 30-day cycle. So that ratio of premium to time is significantly higher in this particular example. Yeah, that's what we're trying to do.
Just to add in a little context too, when we talk about implied volatility landscape changing a little bit, prior to the pandemic, volatility itself, if you looked at the VIX or VIX futures, there were multiple points of contango built into there, right? So front volatility might be in the 14 or 15 handle, and further out expiration volatility would be 17, 18, 19, 20, something like that. So there was a big skew in where implied volatility was. It was very much skewed towards the back. Back month volatility is naturally going to be higher in 99% of market circumstances, other than when you have extreme realized volatility where you flip into backwardation. But when you're in contango, you always see volatility in the back higher than what it is in the front. And it used to be very, very significant. Now, the volatility in the curve of volatility has been very, very flat, right? We might have the lower end right now, in the short term being at 20 or 21, and the back might be at, 2150. or 22. You might have a very small amount of difference in volatility in the market as a whole. And that's what we mean by a change in the implied volatility landscape, in that it used to be very, very low in the front. Now it's kind of consistent across the board, and that's why the we've been able to kind of come to this trade idea, is because that is applicable across the board to the individual stocks as well. So it's not to say that it's going to stay too. It can change. Volatility is dependent on what is going on in the market and option prices. So it's not necessarily going to always stay like this forever, but that's just kind of how we've taken advantage of it in the last couple of years.
Yeah, and we did a segment with Jacob on this, and he showed that even when you're looking at SPY or the Qs, you still see this sort of front-loaded IV. But of course, if you're doing it around a binary event, it's going to be way more exaggerated than if you are doing it in a regular environment, like just trading an ETF.
Yeah.
If we go on to the next slide here, we can get a little bit deeper into the strategy at hand. So when we're looking at these implied volatility landscapes and double checking that it actually exists in the product we're trading, this isn't just a given, like Nick is saying. You still want to double check that whatever you're trying to do in a particular product, it exhibits these characteristics that we're talking about. We can create a more efficient calendarized setup with these implied volatility differentials compared to a vertical setup, which just means trading the same expiration. That doesn't mean that one is going to outperform the other. There's trade-offs in this, but when it comes straight down to implied volatility being efficient in terms of what you're trying to do with selling a short option and buying a long option, if you're pushing that short option into the near-term cycle with really inflated IV, it's going to be a more efficient setup than if you were to have done it in a vertical expiration or a more long-term expiration. So when we're selling a near-term IV, we want to make sure that the premium relative to time is inflated. We can look at the near-term expected move relative to the back month and just kind of extrapolate that across time, like we did in that previous example with the 5-day option trading for $2 and the 30-day option trading for $4. When we're looking at buying long-term IV, we really just want to see that the implied volatility curve is pretty flat. This helps us avoid an IV crush, which hurts extrinsic value in the long option if you do realize that crush. So if we pop over to the next slide, we can take a look at a PayPal example. So PayPal reporting earnings today after the close, trading around $75. So if we look at these different expirations, and we've done this many times before with the different earnings previews, but to kind of hammer this concept home, looking at the 4-day cycle, the option expected move is $5.37 in this image, which is 70% of the expected move relative to the 39-day. And you can see that there. The 4-day cycle, 89.8% IV. 39-day cycle, 47.7% IV. So the IV is significantly higher because that cycle is holding on to extrinsic value premium because of this earnings announcement. It doesn't mean the 4-day cycle is going to be or have a more expensive option than the 39-day. If you're comparing two cycles, the 39-day will still have a more expensive option. But the question is, how much more expensive is it really going to be, given that the 4-day versus 40-day is literally 1/10 of the time you have to hold on to that trade, and you're getting 70% of the expected move. Right. So this is a good example of a differential that we can kind of attack with a diagonalized or a calendarized trade, I should say. With that said, we're still going to see a little bit of an IV crush in that 39-day cycle that is kind of that yellowish, orangish rectangle. 47.7%, and then you look at the back months in that bluish rectangle there, 44.1, 44.9, 43. So we can see that 74 days and beyond, we are seeing that kind of flat implied volatility structure, where at 39 days, we're still seeing a little bit of an elevation. That doesn't mean we're going to get a massive crush in the 39-day, but we should expect to see, I would say, a 5% crush or more. because 5% would bring it down to 42.7. And that's kind of in line with these others, assuming these others don't crush, which they probably will too. So I would say if we were looking at the strategy, I would bake in at least a 5% contraction in the 39-day. Just to be on the safer side. And I would argue that these will probably go to low 40s, maybe even high 30s, depending on what happens. Mm-hmm. But this is kind of how we look at this. We look at the expected move in the 4-day. We look at the expected move in the 39-day. And we say, okay, $5 relative to 7. That's a pretty big chunk of the monthly expected move. And when you look even further, like a 4-day versus 74-day, you can collect, or the differential is about 50%, which means you're going to be able to collect a huge chunk of premium in the 4-day relative to 74. Mm-hmm. And if we pop over to the next slide, we have kind of visualized this in a little bit of a different way. So this is going to be really cool. We're going to look at this today, and then we're going to look at this tomorrow. So what we did with this stock here, and we did this actually we're going to do this with some others as well, but we're just looking at premium on the horizontal or the vertical axis here. So going from 0 all the way up to $10. And then on the time axis here, we're just looking at days to expiration. So 4 days, 11 days, 18 days, 25 days. What are the at the money premiums? So I looked at the 75 put specifically. Mm-hmm. And just looked at the premium relative to time. And as you can see, the premium from the 4-day to the 46-day is pretty much a very similar number. I don't want to say same number because like you're seeing, it's still going to be more expensive the further out in time you go. But you can really see the effect of the near-term implied volatility in this visual here. The 4-day...
It's not linear stair-stepped.
Yes.
Right.
Correct.
So like the 4-day option is not half as valuable as an 8-day option. There isn't that linear slope of stair stepping up where it's, if you sell something with 10 days that's worth $1, it's $2 at 20 days, it's $3 at 30 days. That's not the case here. And that's because of the skew in volatility that is present in the front of this curve. Right. So the volatility skew that is heightened in the near term is why those options are more expensive relative to the 46-day, where even though it's the same option and with more time, it's not exactly a multiple of what it is in the short term.
Yep. And what we're doing with these sort of strategies to kind of visualize the setup is that we're selling this 4-day cycle. So all the way on the left, we're selling that option, and then we're buying somewhere around the 46 to 74 day. So you can see right at that 46 to 74 day is where the premium really starts to kick up higher. And that's because you're just adding so much time value to that trade to where it's going to increase the extrinsic value overall. But this really shows you that when you're looking at different premiums, selling why would I sell the 18-day when I can sell the 4-day for virtually the same price and get all that premium by Friday? And that's kind of what we're aiming to do, is take advantage of trying to get as much premium as possible in the lowest amount of time as possible to reduce the cost basis of the long option we're buying. And this applies to calendar spreads, diagonal spreads, ratio spreads, broken wing butterflies, whatever you're doing. This is what we're trying to play for in terms of just getting an efficient setup on the trade entry.
Yep. And keep in mind that after the 46-day, the scale is a little bit off, right? It's not the exact same. There is more time there. So it curves up because there's more time there. But you could see for yourself that, the 4-day relative to the 74-day, you would think it would be 20x the value if it was linear, and it's clearly not.
Yep. And tomorrow, after earnings are released, we also jotted down the implied volatility numbers as well. So we'll be able to graphically show you how those implied volatility numbers contract as well after earnings. So tomorrow, what I'm expecting to see is that this kind of flat line from 4 to 46 days is going to become much more linear. So the 4-day is going to drop aggressively, and it's going to look much more like the range from 46 to 256 if we're looking at this. There still will be a little bit of a inflation in the near term, but it's going to be much more linear across the board.
Cool.
All right. So if we get to the next slide here, we can kind of look at a different example. So Apple reported earnings previously, and because they've already reported, all the implied volatility from a binary announcement, at least, has come out of this implied volatility landscape. So you can see here, all of these expirations are between 24% and 28%. So this shows you what we are going to expect from PayPal. And if you were to look at these side by side, you can then clearly see that the implied volatility numbers really climb as you get closer to expiration in PayPal. And again, that doesn't mean that there's more premium in the 4-day than the back month. It just means that because there is somewhat more premium relative to if there was no earnings announcement, that's what's really driving that IV number higher. So this is what we would expect to see in PayPal. Now, what that number is it 35% across the board? Is it 40% across the board? Time will tell, but that's why we want to kind of bake in these IV crushes, regardless of where we are on the expiration plane, just to make sure that, okay, if we're expecting a 5% contraction in the option we're buying, we know we're getting all the premium in the 4-day cycle that we're selling. How does that play out in terms of a diagonal or calendar spread?
Beautiful.
And we got one more quick takeaway slide here. So from a theory standpoint, and again, for the rest of the week, we're going to extrapolate this theory into different strategies, and we'll break it down more clearly with specific strategies. But of course, these trades are not guaranteed. They're not free paychecks by any means, but they are more efficient setups when you think of how quickly you can get that short premium in your pocket as cost basis reduction against your long option. With that said, you still need the market to behave. And what that means specifically depends on your strategy. So if you do a call diagonal spread and the market drops, you're going to see losses on that trade. But you're going to see less losses than if you just had the long option, for example. And we like to say short premium can be seen as sort of a temporary mulligan to a degree, which means whatever that short premium is that we're collecting for sure by Friday, if we're selling a weekly cycle, in this example, if I'm collecting $3 with 2 days to go, that $3 can offset $2 or $3 against me in terms of a move against me. So like if I do a call diagonal spread and I have $3 in short premium, if the stock drops $2 or $3, maybe I'm a scratch, maybe I'm a small loss, maybe I'm a small winner, but that short premium does help offset small moves against you.
Yeah. You just have to keep in mind the short premium does cap your tail upside. Yep. Right. So there's always going to be a gimme and a gotcha, as Dr. Jim would say. You know, if you're doing a diagonal spread and you're buying it at the money and you're selling a 20 delta in a shorter duration, you're capping where your long options profit potential intrinsically can go. So there's always going to be a trade-off. You're always going to have to give up that tail in exchange for that mulligan if you're wrong. But you have to keep in mind that, you know, the tail events are much more rare. And, you know, for the 90% of the time, you'd probably be better off just having the short on.
Yeah. And if it's a diagonal spread and it's set up in a way to where even if the spread moves deep in the money, you're still profitable. You're still going to be profitable at the end of the day. It's just... Yeah. You can't really play for those 2-3x earnings moves that don't happen all that often.
Mm-hmm. Good stuff.
And that's it.